From the morning reading, the SPX has a new all-time high close following the jobs report. Financials rise. 8 of 9 sectors moved higher on Friday. XLF, XLY, and XLI were the strongest sectors, while XLU was the weakest sector. Oil futures rose 17 cents to close at $41.98. Breadth strengthened compared to the prior session as advancers led 21.33 to 8.24 on the New York Stock Exchange and led 18.54 to 7.21 on the NASDAQ. After 16 days grinding in a sideways channel, sometimes referred to as a horizontal bull flag, the SPX breaks out and makes a new all-time high close at 2182.87. On that S&P 500 snapshot, the record closed on the strong jobs report. This morning's unexpected strong jobs report cleared the launch pad for a market liftoff. The S&P 500 surged upward at the open and continued to rise at a subdued pace to the lunch hour high. It then traded sideways until the final minutes when a bit of buying near the close inched it above the lunch hour high to close at its 0.86% intraday high, which is a new record close. The yield on the 10-year note jumped 8 basis points to 1.59%, a clear pause in flight to treasuries that has been the general trend of 2016. Also in the morning reading, that strong job report pushes stocks and bond yields higher with financials in the lead. Bank, broker, and insurance ETFs strengthen. Leaders include Bank of America, Charles Schwab, and Lincoln National. The NASDAQ composite nears a record high. Microsoft reclaims new record. Financials Spider hits an 8-month high. The daily bars on the Financial Select Spider XLF break through its spring high to reach its highest level of the year. Its relative strength ratio has been rising for a month and appears to be bottoming as well. Of all the sectors in the market, financials are the most sensitive to the direction of interest rates. Their upside breakout appears to reinforce the view that bond yields have bottomed and that the bond prices have peaked. The three financial groups that benefit the most from rising yields are banks, brokers, and life insurers. Not surprisingly, these three groups are leading the XLF higher. REITs, which are hurt by rising rates, are the day's weakest XLF performers. The NASDAQ composite nears a record. Microsoft is already there. The NASDAQ composite index is on the verge of joining the Dow and the S&P 500 in record territory. The chart shows the CompQ trading at the highest level in a year and on the verge of clearing last July intraday peak at 52.32. The NASDAQ 100, which includes the 100 largest non-financial stocks in the NASDAQ market, has already hit a new record, as has Technology Spider XLK. The NASDAQ and technology sector are being led higher by big tech stocks that include Amazon, Alphabet, Cisco, Facebook, and Intel. The NASDAQ's biggest stock, Apple, has gained 13% since the start of July and has cleared its 200-day average and is trading at a 4-month high. The NASDAQ's second biggest stock is doing even better. Microsoft hitting a new record high today to reaffirm its bullish breakout that took place during July. Its relative strength ratio is climbing as well. It's hard not to be positive in the stock market with big technology stocks like it leading it higher. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is currently 6:22 a.m. Mountain Time, and I'm recording this in preparation for the market day of August the 8th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And at the time of this cut, all four broad market U.S. indices were up just above scratch. Nothing really more notable than that. Crude oil, though, is notable in that it's up almost 2%. Euro's down just below scratch, as are bonds. Gold is down about just under 0.5%. In overseas action in the key markets, you have China up almost 1%, Hong Kong up about 1.5%, Japan up almost 2.5%, Germany up almost 1%, and United Kingdom just below scratch. In terms of macroeconomic reports for today, of note for the United States, there is nothing on the calendar that should be a market mover. Looking forward to tomorrow, you have non-farm productivity and unit labor costs. Mortgage delinquencies report somewhere in the 9th through the 12th time frame. And that looks to be about it. So relatively small amount of significant scheduled events at the beginning of this week. In terms of current volatility conditions, as you would expect with all-time highs, volatility is just getting super, super, super low. Short-term VIX almost down to a 9. Skew did come up a little bit. It's at a 130.6, so definitely in the caution warning area. Look at these IV percentiles. Not only are they low, they're all below 5. And 3 of them are at 0. In other words, they have not been this low in their volatility in the last 52 weeks on the Russell, NASDAQ, or Dow. The S&P is at a 4 on the implied IV percentile. You did have standard deviation moves put in on Friday with the S&P and the Dow at least 1 standard deviation move, and then you had the Russell and the NASDAQ at a 2 standard deviation move. So after a period of extremely quiet volatility, you've had the standard deviation moves start to really pick up in recent sessions. Albeit at this point, they're bullish, and we have a very important bullish breakout. And let's go ahead and go to the charts. So we'll start with the S&P futures chart, and you see, as one of the morning authors from the reading suggested, we had a breakout of that pattern, and it was some 13 trading sessions in length, and really probably you had the firing of this on Thursday, where you had this bit of a flag pattern breakout, and then certainly the Friday is a confirmation in that it broke out of what was referred to as a horizontal bull flag pattern. And then that so far today, and of course it's just Globex activity, not yet confirmed by all market participants, but on an intraday basis, you've got a new high that has been put in. So certainly building on the prior activity, and seems to be reinforcing at this point this breakout. So we talked about that there was 2 possibilities in this pattern. One was that we'd have a retracement back down to the prior resistance turn support area. And then the second one was that you just simply have a consolidation by time and then eventually a breakout continuation move, much like this bull flag pattern. So in some ways, you almost got both. You had obviously this bit of a retracement, and on an intraday basis, kind of tested fairly close to the prior support line, and then a flag pattern and a breakout setting up from that. So not classic in that we didn't come all the way down and truly test the general area, but we certainly got very close. So that's something to kind of consider. But right now, bottom line is we seem to be breaking out long, and there's not an awful lot to be concerned about if you are measuring risk to the current market conditions or bearish probabilities. When you look at the Dow, you see the same thing here that we've drawn a number of sessions ago, this diagonal resistance area, and this is a clear breakthrough, and you would have had an obvious entry signal when you cleared that area, and so far also confirming that. Now this will be even stronger once it clears that swing high, and you also have a horizontal breakout. So look and watch for that 18565 area. You need, you know, some 80 points or something like that on the Dow today to be able to get back to that area and see how the Dow performs once that is achieved. And in terms of the Russell, of course, the Russell had a 2 standard deviation move, and you see that that flag pattern not only fired, but is also following through, and it not only fired and broke through that diagonal resistance and setting up the bull flag, but also went all the way past the horizontal resistance. So this was a strong, very strong breakout pattern that frankly achieved its first target within the intraday on Friday and then went on. In terms of the where this might be going, you note that this is a 52-week high. So let's take a quick look at the 2-year. And you see we have the all-time highs are still from back in last June of 2015. So this 1292 area is still looming out there as horizontal resistance. And unlike the Dow and the S&P, and now even the NASDAQ, you have the Russell that's been trailing. And we'd like to see greater vigor from the Russell and playing not just catch up, but also taking a lead as the index of largely growth-oriented companies, those small caps, that are often the ones that are the markers of a strong bull market, will them to be making actual all-time highs. Now, given that since the February lows, I mean, we were at 936 at one point on the Russell futures back in February, and at this point we are now up here at 1231. You know, this percentage move during that time is a very, very healthy bullish move. And if you had been a bear anywhere in here with very short kind of relief moments, you've been pretty much on your heels the whole time. So while the Russell has got some work to do in catching up and making that all-time high, it is also doing so a pretty solid clip. And the other one, of course, is the NASDAQ, and we did have some significant activity set by the NASDAQ with new all-time highs coming in on several of the NASDAQ measures. And you see here on the 52-week, it cleared that prior swing resistance area where we'd had a bit of a bull flag set up, and then on Thursday that fired. Friday confirmed, and confirmed in a big way, breaking through the prior horizontals. And then so far today is actually following through and building on that confirmation. So very, very strong action across all 4 broad market U.S. indices for Friday. So let's take a look and see if the other markets are confirming that action. And you see that bonds were down on Friday, and then gold got crushed on Friday. So people definitely seem to be moving out of the bonds and gold into those higher beta risk on kind of elements. And then we can also take a look at see what's going on with crude oil. Crude oil seems to have found the bottom from this recent extremely bearish action, and that would represent you know, a brighter view on the economy and more demand for energy products. And then finally, let's take a look at volatility. As you would expect, volatility getting exceptionally low, and on Friday was down to almost an 11. So as volatility continues to come down from that post-Brexit spike, volatility has been crushed very quickly, and it continues to ebb down as this bullishness sets up. Now we are on a VIX daily squeeze, and you can see this compression here. So at some point you're going to look to see this volatility expands, but in terms of those signals being imminent, that would not seem to be the case. Let's see, that's probably enough on the charts for right now. Let's go ahead and go to the daily report. We've had a number of changes here on the daily report. And first of all, in terms of our market trend intermediate term phase opinion, this is currently in phase 3. This is a bullish phase, bull flag fill, and we certainly saw that setting up at the end of last week in all the important charts. In terms of the 3 market timing signals, for the first one from IBD, we have confirmed uptrend, so bull sign there. The second one, GMI index, we actually dropped a point to a 5 out of 6 on the GMI index and the GMI 2 to a 7 out of 8, but still both of them solidly bullish signals, and that buy signal has been in place now since July 1st. And then the third one is the stock charts decision point scoreboard. And we've had some short-term signals that have gone bearish in recent sessions, but they should frankly be on the verge of flip-flopping back for the bullish. So we can't ignore the fact that there's some of these signs there, nor can we ignore the fact that there are, in the long term, mixed signals. So there are some signals of not uniformly healthy bull, strong bull kind of setups in our market timing signals, but at the same time, the consensus here is clearly to the long side, the bull side, with some asterisk to it. Position sizing opinions on both models, both the portfolio investor position sizing as well as the more active trader volatility models are both at 100%. The intermediate term market postures are all very, very strong, and you see they're all up over 80 easily, with 3 of the 4 up over 90. This is also reinforced and supported by a bullish sentiment line. So that means that we expect that bullish moves to be longer or more pronounced than the bearish pullbacks. And the strength of the trend you see is exceptionally high, and just because it's high does not mean that this is a reversal expectation. As you've seen back here, it can stay in that upper zone for extended periods of time. So you know, this is a very strong strength of trend indicator level at this point. Hedge warning status remains 0+, normal with some cautionary aspects, and we see that with some of those market timing signals and the like. From a special opinions standpoint, option income strategies, VIX is acceptable to initiate new positions for novice traders. I will put an asterisk on this. We're down below 12 at this point, so some traders will stop trading option income strategies when the VIX drops below a 12 because the premium at that level is very low. So your benefit to take that trade versus the amount of risk that you take on is getting to get a bit skewed. And then, of course, as you get very low volatility, at some point that's going to set up for a volatility expansion, and that can be a problem for option income strategies oftentimes. So depending on how you set those up. So bottom line is we're leaving this as acceptable. We do not see that there's anything that's currently painting itself as particularly risky in the market profiles, but at the same time, you have to start watching yourself with those option income strategies. Are you getting paid enough for the risk that you're taking? And perhaps, you know, you need to take that into account in your position sizing or even in what trades you take to set up. In terms of cover call strategies and put selling, conditions are acceptable for new positions by both. Consider adding as you develop confidence in this move, but you know, we've now had a all-time breakout, and then that all-time breakout's now legged up for a second breakout. So you have to start putting more bullish exposure in, is the typical expectation, and certainly also in the way we're conditioning these with a 1-to-2 ratio of in the money, out of the money, and a 1-to-2 ratio of low beta versus high beta, taking on additional exposure given the current market conditions. In terms of specific warnings, we have the same 2 kind of relatively low grade warnings, and that volatility ratio is back into that reset area and awaiting firing. That daily squeeze is also set and awaiting firing. So those will probably fire off at pretty much the same time. And then skew continues to be a bit elevated. It was for a number of sessions there just in the first level of caution at above 125. It's now eked up above 130. So, as that goes up, especially as it goes up over 135, the probabilities of a 2 standard deviation move within an intermediate term time frame start to build. In terms of trend base, everything is solidly bullish. In terms of intermarket risk aversion indicators, we've actually had, one of these go back to risk on, and indeed, there was just a little bit of a wiggle to where this fired as risk off and now has turned and fired back as risk on, and some of these others that are still off as risk off are also looking like they could very quickly go back to the risk on kind of setting. So a little bit of whiplash going on here, but these lines are kind of wrapped around each other and very little separation and angle to them. So kind of keep that in mind. We did see these, which we often see as the most sensitive and early signs of change in that market posture, and we did see these start rolling risk off, and indeed we did have a pullback materialize, but then they very quickly have started to turn the other way, and we've also seen market action start to turn more bullish. So there does seem to be a very good sensitivity between these indicators and the expectations of pullbacks especially. At the same time, these are lagging, as are most indicators, and it just helps us understand a little bit about what's going on inside the market internals, perhaps in a different way than other indicators such as trend-based and volatility-based give us. Another way that we look at the market is from sentiment, and our fear and greed index is at very, very high sentiment levels. Remember, 90, there's only like 5% of days in which you are over a 90. We are very high with an 86 here in that upper quartile. So, that's something also to kind of keep in mind. That said, sentiment, emotion can run high and stay high for extended periods of time. So all this does for us is makes us raise our radars and be sensitive to reversal patterns. But until we see those reversal patterns, we don't just simply automatically expect that high sentiment means a retracement. In terms of sector specific, quite a bit of healing here. This was pretty ugly a few sessions ago, especially in the short to intermediate term. And at this point, only telecom, consumer staples, and utilities on the short to intermediate term are looking relatively poor. And frankly, there's probably money coming out of all three of those sectors and going into more risk on. And we can see that on the 1 day. You see utilities, you see telecom, you see consumer staples, the three worst performers on Friday. And at the very least, it would seem that money was perhaps coming out of utilities and going into more risk on. Of course, the big story was financials, and almost a 2% day for the financials. And also information technology, consumer discretionaries, industrials, all these high beta, risk on kind of sectors were performing well on Friday's big breakout. Also, we'll take a look at the relative rotation graph, and you look just at how many different sectors or industry groups are moving with very nice tail patterns moving into that upper right quadrant. Those are all very strong moves. So you've got the biotech, and we've been seeing how healthcare, specifically the biotech area, has been gaining. Telecom, internet index, U.S. real estate, semiconductors, home construction, all doing some very, very strong activity in recent trading sessions. So if those are not on your watch list, you should take a look at them. Also note that XRT retail is starting to rise as well. And you don't see it on here, but XLU, of course, has been going from a strong position and weakening, and so that activity is also reflected. Okay, that's probably enough for today. Monday sessions are often packed with information, and this one was no exception. Let's go ahead and get this thing to production and get it published. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the full set of disclosures can be found at that hyperlink that's down here at the bottom of the slide. In the meantime, we'll see you next for the next market trading session and Falcon Global with the market preview. In the meantime, manage that risk. You'll find that everything else will follow on very nicely. And each day, seek to go out there and learn something.